Every momentum investor eventually asks this question: how many stocks should I actually hold? 5, 10, 15, or 20? Most people assume that holding more stocks automatically reduces risk without sacrificing returns. But after running a 10-year backtest on the Nifty Large Midcap 250 universe, the results completely challenge that belief. One portfolio almost doubled the wealth created by another. And surprisingly, the safest looking portfolio wasn't necessarily the smartest choice. When people first discover momentum investing, they usually focus on one thing: finding the best momentum stocks. But there's another decision that's just as important: portfolio size. Imagine you have the top 20 momentum stocks available today. Should you buy all 20 or should you only buy the strongest 5? Intuitively, holding more stocks should reduce risk. But diversification has a hidden cost. Every additional stock forces you to allocate money to lower ranked opportunities, which means your overall portfolio may become average. Today we'll find out exactly where that trade-off begins, and by the end of this video, you'll know which portfolio size delivered the best balance between return and risk over the last decade. Before looking at the results, let's understand the strategy. We are using the Nifty Large Midcap 250 universe. Every month, we rank all eligible stocks based on relative momentum. In this case, stocks with the highest percentage price appreciation receive the highest rank. But not every stock qualifies. Each stock must satisfy two simple filters. First, its current price must be within 90% of its 52-week high. This ensures we are investing in stocks that are already showing strength. Second, the Nifty index itself must remain above its 100-day exponential moving average. This acts as a market trend filter. When the broader market is weak, the strategy avoids taking fresh positions. Every month, the portfolio is rebalanced using the latest rankings. The only thing changing in today's experiment is the number of stocks we hold. Everything else remains exactly the same. To keep the comparison fair, every portfolio follows identical rules. Starting capital 5 lakh, backtest period 10 years, no additional investments, monthly rebalancing, same momentum ranking, same market filter, same stock universe. The only variable changing is portfolio size. We'll compare 4 versions: 5 stocks, 10 stocks, 15 stocks, and 20 stocks. Now here's where things get interesting. Most investors expect larger portfolios to produce similar returns with lower volatility. Let's see if that's actually true. A quick disclaimer: this backtest uses the current index constituents for historical testing, so it does include survivorship bias. Historical point-in-time index constituent data are not yet available in Quantinuous, but we are working on adding them and will update you once it's ready. Let's begin with 20 stocks. After 10 years, 5 lakh grew to 50.23 lakh. That's a CAGR of 25.95%. Maximum drawdown about 15.88%. Already an impressive result. But remember, this is only our starting point. Now let's reduce the portfolio to 15 stocks. Final value jumps to 60.29 lakh. CAGR improves to 28.27%. Interestingly, drawdown barely changes. Next comes the 10 stock portfolio. Final corpus reaches 68.66 lakh. CAGR climbs further to 29.95%. But here's the surprising part: maximum drawdown actually falls to just 13.63%. Higher return, lower drawdown. This is exactly the opposite of what many investors expect. Sometimes adding only your highest conviction momentum names creates a cleaner portfolio. Now, the 5 stock portfolio. Final wealth 77.07 lakh. CAGR increases again to 31.46%. This is the highest return among all 4 portfolios. The drawdown does increase to around 25.49%. So yes, higher concentration brings higher volatility, but it also generated the strongest wealth creation, and that's the trade-off we'll analyze next. So why did this happen? Momentum investing follows a simple principle. The strongest stocks often continue outperforming. When you hold 20 stocks, you're forced to include stocks ranked 16 through 20. Those aren't bad stocks, but they're usually weaker than the top 5. As a result, your portfolio's average momentum decreases. This is called performance dilution. Every additional lower ranked stock slightly reduces the portfolio's expected return. That's why concentrated momentum portfolios often outperform diversified ones, but concentration comes with a price: larger swings, higher volatility, and deeper drawdowns. Now, here's something worth noticing: the 10 stock portfolio produced nearly the same CAGR as the 5 stock version while experiencing almost half the drawdown. That makes it an extremely attractive middle ground. If you're an investor who struggles emotionally during market corrections, the 10 stock portfolio may actually help you stay invested, because the best strategy isn't necessarily the one with the highest CAGR, it's the one you can consistently follow. If you'd like to test different portfolio sizes, momentum filters, or stock universes yourself, you can run the same backtest on Quantinuous platform. The link is in the description below. Every week, we publish evidence based momentum investing research, backtests, and practical insights designed for long term investors. If you enjoy data driven investing without the hype, consider subscribing. And before you go, I'd love to hear your opinion. How many stocks do you currently hold in your portfolio? 10 or 15 or even more? Let me know in the comments. I'll see you in the next backtest.